All right, then we will start this from the place where we have stopped. We were talking about leasing and attempted activity number 10.1, and I asked you to attempt all the other activities as we have to quickly finish. Now let me share the screen first. No. So we finished activity 10.1. The subsequent now next step, what we discussed and tried in activity 10.1 was to initially recognize right of use assets arising from a lease. We know that assets or any assertions are subsequently measured. Subsequently also, there is a requirement mainly due to significant changes in value. What is the situation of subsequent measurement of right of use asset arising from lease? So also it also follows the more or less the same rule, like in the case of property, plant, and equipment. We'll quickly have a look. The basically we do this thing in line with basic accounting principles and accounting standards. Therefore, subsequent measurement also would be like this. If the right of asset, like initial recognition is at first model, you know that there are two models for property and property, plant, and equipment. And there are different ways to recognize investment properties. Likewise, for different assets, different models are there. For property, plant, and equipment, cost model and revaluation model are used. To greater extent, right of use assets in a lease relate to like physical. We do not categorize them as property, plant, and equipment, but they are the item that we buy under lease. Maybe building, machines, land, any other thing. We can outright purchase those things or we can lease them. So therefore the nature, physical structure, appearance of those assets are the same, even though we classify them as right of use asset. So in the case of cost model, if the cost model has been used to recognize the initial or the initial recognition, then we need to follow either of the following two options. Number one is if a lease applies the fair value model. Sometimes lease has to go with the fair value model to recognize its initial cost or initial recognition. If that is the case, we need to use the fair value model, like in the case of LKS 40, with respect to investment property. As I just told you, assets can be leased. Whatever the assets that we bought under lease agreement could be sometimes classified as investment property, or the nature of investment property, or nature and the structure of property, plant, and equipment can be seen. If it is an investment property, then we need to follow the fair value model. If the right of use assets relate to the class of property, plant, and equipment to which the lease applies, then the revaluation model can be used. Revaluation model can be used. So then again, if I just summarize, three scenarios would arise. Basically, we follow the um, present value or the fair value when there is a lease. But when we think of the subsequent measure, we need to additionally consider whether the both asset is going to be classified under investment property or property, plant and equipment. If it is going to be as an investment property, subsequent measurement is on fair value. If we are going to classify it as property, plant and equipment, subsequent measure will be on revaluation model or cost. It depends. If we follow the cost model, the same rule applied in property, plant and equipment should be applied here. We know that. Then how are we going to subsequently measure the right of use asset at cost initially, then less any accumulated depreciation and any accumulated impairment losses. So the second item is a little bit exceptional because everyone knows about depreciation, but impairment losses will not frequently come. So because of that reason, we could be very careful. We need to test uh, asset, right of use asset every time to check whether there is an impairment loss. Then adjusted for any remeasurement of the lease liability specified in the standard. So again, point A and B, in the subsequent measure, of course, you need to bring down your value by the amount of accumulated depreciation and accumulated impairment loss, that they are common and embedded things. The second one is little bit rare situation. That is point number B. You have to make some adjustments to the uh, carrying amount of the right of use asset in the subsequent measurement when there is a change in the lease liability. It does not happen under normal circumstances. Actually, it happens due to the conditions given in the agreement with respect to interest rates and any other things. Otherwise, lease liability will remain fixed. Now, depreciation of a lease asset. Lease asset. No matter whether it is right of use asset or property, plant and equipment, we know we have to depreciate. Everyone is familiar with the concept of depreciation. Here, we have to ask a separate question. It's not the way of depreciation, it's not the method of depreciation because we know how to depreciate, how to use different methods. But before depreciating, we need to ask a question about the time period. We know the depreciation is spreaded throughout its lifespan or maybe on a particular different basis. So therefore, that has to be clear first. If it is a lease asset, the question number one that you should ask, you can go through this chart, but I'm just explaining you how to classify it easily. The option number one is when we depreciate a lease asset, first we have to think, no matter whether it is lease, property, plant and equipment, yes, unless a different um, method has been proposed, we follow um, the basic rule called useful life rule. Useful life rule. That means you always think in your mind, like keep it in your mind, saying that, okay, depreciation, it's proper if you can depreciate based on its useful life. Its useful life. That is number one. Therefore, that rule also applies here. What is the exception when it comes to lease asset here? Sometimes there may be differences between useful life and the lease term. Useful life and the lease term. I repeat it again. Number one, what dominates is the useful life. Always take the useful life. But before taking the useful life, ask another question. What is the lease term, time period, right? How many years? That is what we call lease. There would be three scenarios. One is the useful life is exactly equivalent to the lease term, or maybe greater than or less than. For example, useful life may be 5 years, lease term is also 5 years. Then no problem. So you take the useful life. Second example, useful life is 5 years, lease term is 6 years. Then again, we don't have any problem. Why? So, based on a systematic argument, useful life is less than the lease term. Therefore, give the priority to useful life. Third scenario is useful life is less than the lease term. Example, useful life is greater than the lease term. First one is equal, second one is less, third one is useful life is greater than the lease term. Useful life is 5 years, lease term is 4 years. In that situation, you have to ask a question. Um, if the ownership of the asset, the lease asset is transferred to lessor or not. The ownership of the lease asset is transferred to lessor or not. So our decision depends on that. If the ownership is transferred, then simply we can disregard the lease term. Okay, that means lease term is 4, useful life is 5, but the ownership is transferred to us. That means in economic substance term, asset is going to be with us over a period of 5 years. Therefore, it is logical, systematic to depreciate over 5 years, then you need not to worry about 4 years. But the problem arises if the ownership is not going to be transferred to lessee. The same example, lease term 4, useful life 5, ownership will not be transferred. If the ownership is not transferred, even though the useful life is 5 years, asset will not be with us for 5 years. It is only be with us only for 4 years. So that we have to return the asset after 4 years. Therefore, it is not logical for us to depreciate based on the useful life. Then take the lease term. Again, I summarize, simply follow the rule of useful life without considering anything. But if the useful life is useful life is greater than the lease term, you have to ask a question. What is the question? Whether the ownership is going to be transferred. If the ownership is transferred, then again, no problem, you can use the useful life. But if the ownership is not transferred, you have to ask a question. Then lesser period is the lease term, therefore depreciate based on the lease term. So that is the rule of thumb. Impairment, I think, may have been discussed under LKS 36. When there is an impairment, you know how to adjust. By the same amount, value of the asset should be reduced. So this is what I already explained. Subsequent measurement. What happens then when there are changes, the value of the asset should be adjusted accordingly. In case of interest rate accrued with respect to liability, the previous one we talked about the lease asset. We know that lease asset can generate, at the same time lease liability also generates. Now we talk about the lease liability. lease liability. That is the amount to be paid, amount to be settled. It's our liability, your obligation. This is an explanation what we did. I think need not to go through in detail because you know how the lease liability increases. So all these the write-up can be explained in one sentence like this. You recognize the liability at its fair value initially. That is the present value of lease payments due at that time. Subsequently, what we have to do, you make payments, subsequent payments. So therefore, lease liability is reduced by the amount of payment. But at the same time, you need to add the respective component of interest for the given time period. The beginning of the time period, take the lease liability, add the interest for the given period, deduct the lease rental paid. Then that would be the final lease liability, unless there are any other adjustments arising from other terms, condition clauses, for example, variable interest or any other things. Other than that, follow the simple rule: opening balance plus interest minus rental repayment. That would be the lease liability. Presentation: all expenses arising from lease should be recognized in the statement of profit or loss in two ways. Number one is the interest charge, or the difference or diminishing amount of the lease liability. It is nothing but your interest component. Therefore, it is an interest. Rather, we can call in a broader category called finance expense. But at the same time, you have recognized your asset. That asset also has to be depreciated. Then the depreciation cost will be there. When you go to the balance sheet, we need to recognize this as an asset that is recognized as a right of use asset. Uh, it should be like recognized as a separate item. Separate item. In the statement of cash flows, cash payment for the principal portion. So this is the point. Sometimes we might um, be a little bit confused. Cash payment for the principal portion of the lease liability with financing, like lease, for example, when we make a lease rental of 60,000, you know that how to split it into capital portion and interest portion. Actually, the liability lies with the capital portion and not with the interest. So the item number one talks about this capital portion. Capital portion is a financing equity, of course. You have finance. It's not simple outright purchase. Therefore, out of the 60,000, assume that 50,000 is the capital component, 50,000 is shown under financing activity. There is no option. But when it comes to the interest portion, that is 10,000, according to my example, 60,000, 50 is capital, 10 is interest. That 10,000, we have two options. Actually, 10,000 is an interest. Interest normally links to financing activity. Therefore, if you wish, you can show this thing as a financing activity as well. Alternatively, you can show it as an operating activity. It's not our choice. It is the recommendation given by the accounting standards. But with respect to lease payments for low value, or basically we say that lease of low values and variable lease payment not included in the measurement of lease liability. In other words, in a situation where the right of use asset is not recognized, those payments should be recognized as operating activities. So disclosures, I'm not going to detail it out. You can go through it in the presentation. Basically, as I just told you, method, what we did, impact to the income statement, and the position in the balance sheet, or any other additional information that you may think required for a good decision should be disclosed. Now we will quickly go to activity number 10.2. I hope that you have done it. If you have not done it, I can't help. I'll quickly go to the answer and explain it. This is an extension of activity 10.1. Here, assume that the useful life of the asset is 4 years. Consider the given information in activity 10.1 and assume that the least useful life of the asset is for 4 years. What you are supposed to do is the ledger accounts in the books of lessee and the extracts of the lessee's financial statements for the year ended 31st March 2020. In the example, if you go to activity number 1, this is ABC PLC acquired a machine on this date. Initial payment was 80,000 down payment, installment 60,000 each, and guaranteed residual value is also there amounted to 10,000 and initial direct cost. So they have been added on to the interest rate implicit is 12. So in this activity 10.1, lease term was not given. Therefore, in activity 10.2, lease term has been given, that is for 4 years. Relevant ledger accounts. Initially, to do anything, we need to, before doing anything, we need to ascertain the lease liability. In other words, the present value of lease liability. That has been already calculated in 10.1. What is the amount of lease liability? It is 188,596 amount to be paid, present value of the liability. So you recognize the first journal entry would be credit to this account, debit to your machine account, that is the right of use asset machine. At the end of the year, you need to recognize the interest component. Interest component is 22,632 that has been already calculated. You follow the interest calculation schedule that I've explained in the class. Do it by yourself and realize rather than just simply bringing an item and putting here. Then respective journal entry would be interest expense debit and the lease liability would be credited. Then the total amount is going to be 211,000 something, but we know that at the end of the year, installment, what we call the rental, is paid. So by that amount, the full amount is deducted, therefore carried down, or the balance would be 159,000. The same procedure will continue over a period of 4 years in this case. So at the end, you would realize this is the last one, 31/3/2022, balance will be 0 because we use the implicit interest rate to recognize the interest. If that's the case, there can't be any balance once you make the final payment. But one special thing is noted in the last year. In addition to the rental payment, you can have a look here. Cash payment was 60,000. In addition, there is another cash payment, 10,000. That is nothing but the guaranteed residual value, because we have taken that also into account when we calculate the present value. So therefore, we go to pay it. Right of use asset, machine. So straightforward, this entry comes from the liability account, debit here, credit, use of lease liability account. But this is not the only cost of this machine. Machine has to be, or the right of use asset has to be recognized at its cost initially. Cost comprises of lease liability plus any down payments, we add them, or any other indirect or initial direct cost, initial direct cost. Here there are 3 items. Summation of these 3 items comes to 288,000. So therefore, that would be the carried down. So this is the amount which is recognized in the accounts initially But at the end of the year, um, at the end of the year, at the end of the year, you have to do the depreciation. Then the lease interest, the same thing, that is being deducted from the lease liability account is accounted as an expense here. So everyone understand. Here the last year interest component is less. One thing you can notice in the case of fixed rental payments, interest charge gradually decline. You see 22,000, 18,000, 13, and 7,500. This is one of the inherent characteristics of lease payments, especially when we make um, a fixed installment. Because when we make fixed installment, the early stage of a lease, the capital component is the liability is very huge. As a result, you have to pay a huge amount of interest. Interest cost of a lease liability is relatively high at the early beginning of a lease term. That is an observation for your knowledge. Statement of the profit or loss for the year ending 31st March would be like this. It is straightforward. Depreciation is the, assuming that there is no residual value, 188,000 something is divided by 4 for 1 year. Depreciation is 72,000. The same amount is being charged. You know this. I need not to explain. So these are the interest charges which were explained or seen in the ledger accounts are seen in the statement of profit or loss. Then in the statement of financial position, right of use asset, this is the cost, this is the depreciation. Finally, you can see carrying amount becomes zero at the end of year 2022. Lease liability, when it comes to lease liability, there is a requirement based on LKS 1, presentation of financial statements. Anything that falls in the category of current within a 12 months period or within operating cycle has to be shown separately. The lease liability, every year until 2022, there is a component that you have to immediately settle. When we talk about 2019, there is a component to be settled in 2020. That amount has to be shown as a current liability. How do we calculate this? How do we calculate this? That is most important. How are we going to calculate this? Is the simple rule that you can follow. You take the rental. You take the rental. What is the rental? Every year, 60,000. 60,000. That is the amount um, paid or settled as an installment every year. So therefore, you logically think that, okay, if that is the case, next year liability would be 60,000. Because if there is a rental next year, because in every year you pay 60,000, that is your rental. Therefore, current liability looks to be 60,000. If you do not know anything, I mean, as a layman, if you logically argue, next year's liability would be 60,000. Therefore, this would be 60,000. But there particular adjustment is needed. Out of this entire 60,000, entire 60,000 is not the liability. That comprises of the liability plus interest. So therefore, we need to look at this interest component. What is the interest component for the 2019? That is 22,000. Once you deduct, that case, this is 20, sorry, in this case, so we are talking about at the end of 2019. So 2019 interest component was this much. That has been already paid. It's gone. Now at the end of the year 2019, your carrying amount is not not 288 but 216. So when we show your liability at the end of 2019, it is not this month but this month. Therefore, the liability would be next year's. So what is the amount that is going to be paid next year? 60,000. Then what would be the interest component for the next year? Not this one. That is 18,000. Therefore, 60,000 minus 18,000, that has very carefully done. So next year's installment is fixed, that is 60. But from that 60, what you have to deduct is not the current year's interest, but the next year's interest. Next year's interest. That is 18,000. 60,000 minus 18,000 something becomes this. The same pattern would continue. Therefore, at the end of 2021, there will not be a current portion because, sorry, the 2021 there is only current portion, no non-current liability. Since this liabilities will be settled in 2022, at the end of 2022, there are no liabilities. So I know that all the calculations are easy, but when we make this classification between non-current liabilities and current liabilities, sometimes students might get confused. Therefore, you have to pay careful attention on this thing, study more. If you did not understand, do this exercise again. Activity 10.3. What is special? The same structure follows. Lease agreement was signed on this date. Duration is 3 years. Down payment is 70,000. Annual lease payment is also 70,000. Starting the payment from December 2019. Legal charges. When there are legal charges, that is a direct cost. Then there is a possibility for us to add this thing to the cost. Useful life of the equipment is 5 years. So here there is a difference. Useful life 5, duration 3. Therefore, we need to ask a question whether the ownership is being transferred or not. That information has been given. Note, ownership of the asset is transferred to the lessee at the end of the lease term. At the end of the lease term. What does it mean? The asset is going to live with you over its useful life. Then I just told you very simply, then need not to think of anything. Disregard the lease term, follow 5-year life. If the ownership is not going to be transferred, then you need to depreciate over 3 years. Then compute annual depreciation charge, show the journal entries in the books of lessee, and extract the financial statement. The first, lease liability. That is the normal calculation, present value calculation. Use the discount factor at 10%. Therefore, it becomes 174,000. Then the right of use asset, take the exact amount here, 170,000. Down payment of 70,000 is there. Additional initial cost. You can add all these three together. Then 54,000. This is the cost. This cost has to be systematically allocated over its useful life or any other systematic basis. Here, depreciation has been calculated by dividing this full amount by 5. Therefore, it is 50,000. Now you got the point, right? We go back to this question again. Ownership, useful life is 5 years, duration 3 years. Then what I just asked you to look at, if the duration or the lease term is equal to the useful life or greater than useful life, you need not to worry. For example, in this case, 5 year, if the lease term is 5 year or 6 year, need not to worry, follow the useful life rule. But here, lease term is less than the useful life, that is 3 years. Only in that occasion, ask the question whether the ownership is transferred. If yes, again, follow the useful life. If not, go to lease term. In this case, it is transferred. Had it been said that ownership is not transferred, your depreciation would have been this amount divided by 3, not 5. I hope it's clear. Activity number 10.4. This is an extension. Up to now, we discuss accounting treatment or implications of accounting with respect to a single lease. In practical situations, when corporations acquire assets through lease, it is a continuous process. There may be so many assets, different type of assets, different classes of assets. If you analyze the total value of lease, it would be many. To get a glimpse of understanding of such a situation, activity number 10.4 has been designed. So here, already you have lease asset or the right of use asset and lease liability. And with that, additional lease is brought up. We'll see how it has happened. Now you understand those who have attempted the activity may be comfortable. Those who have not attempted the activity then may not have any clues, but I can't help. Samanala PLC has provided the following balances. At the end of the year 2019, 31st March 2019, now the balances have been given as of 1st April 2019. Machine 1A. Right of use asset is this much, 282. Lease payable is this much. Accumulated depreciation is this much. That means some part of the useful life has gone. We do not know how much. We have to check how many years have already passed. The interest rate implicit in the lease is 12. That is an additional information. Annual installment is 60,000. Rental is 60,000. Every year, 60,000 should be deducted from the lease payable. Residual value of this machine is 32,220. That's given. If that's the case, you can quickly match this residual value with the right of use asset. That is 282. If you take the residual value out, 32,220, it becomes 250. Therefore, depreciable amount is 250. So those are the things you should quickly do when we read a question before attempting the question. Then once you deduct it, depreciable amount is 250, and you can check that depreciable amount with the depreciation. Therefore, depreciation already charges 50. That is 1/5 of the depreciable amount. If the depreciation has been done over 5 years, this is 1 year has already gone. This is 1/5. Otherwise, it would be 10 years, but we do not know. Question will reveal the information. But as of now, we know one thing, that 50,000 has been charged as depreciation. With this scenario, company acquired another machine, that is 2A, from another leasing company, maybe the same leasing company, for 2 years. The lease term is 2 years. Annual rental is this much to be paid on this date, that is 31st March, each year starting from 2020. Then 2020, 31st March 2020, there will be 2 lease rental. Interest rate implicit in the lease is 14%. The previous one is 12, this one is 12. Sorry, 14, 12, 14. You can see the difference. So this is mainly due to the change in interest rate in the market. By the time we acquired this asset, interest rate had been 12%, now it's 14%. In a way, it explains you the concept of incremental borrowing cost. When the interest rate changes, incremental borrowing cost also changes. According to the contract, risks and rewards incidental to the lease asset are not transferred to the lessee. So here it says this sentence highlighted in yellow says something about risks and rewards of the asset. It does not talk about the ownership of the asset, whether it is transferred. This is to confuse you sometimes, some practical problems. Confusion may be there. What is the confusion? Because we have some experience about this word. What's it? Risk and rewards. Before this LK 6 is pertaining to lease was revised, we recognized lease assets either as financing lease or operating lease in the books of lessee. Now this classification is done only in the books of lessor, not in the lessee. So therefore, the question of whether risks and rewards are transferred does not arise to leasing. Does not arise to leasing. So we can simply disregard this sentence. But if it were a sentence related to ownership, that matters to decide the depreciation. Is that clear? Yeah. So risk and reward involves only in deciding whether it is a finance lease or operating lease, since that is not relevant for the lessee. With the new standard, you have to disregard this statement. It has no answer. Statement of profit or loss for the year ending 2020. Administrative expenses, depreciation arising from machine A, 50,000. Here we made an assumption that useful life of machine 1A is 5 years. That's not there, you better mark 5 years. So 150 has already gone, therefore depreciation is 54. Second one, you need to take the total cost. Total cost would be 100 in the second, yes. Current right of, yeah, this is 197,599. We had done the calculation. 50% of 197,000 is this much. That is your depreciation. In the profit and loss statement, finance cost comes from two leases, 1A, 1, 2. 17,000 is coming from 1A, 27,000 is coming from 2A. Calculations are here. Then the presentation in the statement of financial position under right of lease, right of use asset would be like this. Previous one 282 to 220 plus this 197,000. So therefore, summation of these two is the total cost, but the carrying amount comes to 281,000 something. These are after deducting accumulated depreciation 50, 50, and 98. So it's like not related to lease general. Then as we followed the same rule in separating the liability into non-current liability and current liability, we have to do like this. So for the lease 1A is this much, 2A is this much. So these are the amounts to be settled in next year. Now we will quickly move on to accounting for leases in the books of lessor, the one who sells asset. Okay, before starting, I simply summarize the accounting arrangement or accounting for lease. As I told you, for the perspective of lessee, from lessee's perspective, the lease is a simple arrangement to hire assets. When someone hires an asset on a lease agreement, we talked about specific characteristics of such a lease arrangement, its irrevocability, legal concerns, and all those things. But however, according to the accounting standard applicable for leases, except hiring of assets which have low value or hiring of asset just for a period of less than 12 months, simply recognize the amount hired or paid for the hired asset as an expense. Need not to worry. But the complication arises for other items. Therefore, when we hire an asset under lease agreement for a longer period of time, more than 12 months, or in high value, the accounting. In the case of lessee, lessee is the one who hires, who takes the asset, possession of the asset, uses the asset for his own business operation. Then, irrespective of the legal consequences, legal appearance, take the accounting substance and recognize it as an asset. in the name of right of use asset. That's it. In recognizing the right of use asset, initial recognition would be at cost. Cost comprises of several items. Number one is the present value of the lease liability. Lease liability. Number two is the any down payment made or any other direct expenses incurred by the lessee to bring the asset to present condition and location. Sometimes there may be a guaranteed residual value. Guaranteed residual value, you may have to pay something that has a connection to the purchase option sometime. So those are the things. We take this thing and depreciate the asset. In the case of lessee, so lessee's books, the liability is at its the present value. Over time, that has to be adjusted by adding the respective interest charge by deducting the lease rent. So this process would continue until the lease term is over. In the case of depreciation of lease assets, the rule is easy. Follow the rule of useful economic life. So useful life, but useful life may be distinct from the lease term. If the useful life is greater than the lease term, you have to ask a question. In all other cases, we need not to worry. Follow the useful life. If the lease term is less than the useful time, ask a question whether the ownership is transferred. If yes, again follow the rule of useful life. If not, follow the rule of lease term or take the lease term for depreciation purposes. And finally, classification of the lease liability into two components, non-current and the current. Now you know the full amount. From the full amount, you determine the current liability. How do you determine the current liability? Take the lease rental that is fixed given in the question, easy to identify, 60, 70, 80, whatever, fixed amount, deduct the next year's interest, not the current year's interest, next year's interest. That would be the next year's current portion of the liability of the current portion of the lease liability. Once you have the current portion and the full amount, deduct the current portion from the full amount, it will give you the amount of non-current liability. That is the lease. So that is the summary of accounting for leases in the books of lessee. So you have to expand it. You have to further learn more about journal entries and books of accounts to get more understanding. Hope that had you just gone through and done the exercises, I'm sure that you would be familiar with these. But if you have not done, can't help. I have been repetitively telling this in the class. Now I will look at the books of lessor, one who really gives the asset for hiring. So one who, I mean, passes the asset to lessee in the hire, that is lease agreement, lessor. Here, before talking about finance lease and operating leases, one thing is, I mean, it's good to discuss about one thing. Leasing can happen by two people under two circumstances, no matter whether two circumstances, that person is the lessor. Lessor can be simply a finance company. Suppose that you want to buy an asset. Simple example, so common example that we see in our day-to-day life, even you also may have done, leasing of a motor vehicle. When you lease a motor vehicle, who helps you? Leasing company or a bank to finance. If the value is 5 million, your leasing company or the bank pays 5 million to the seller of that asset, the dealer or the manufacturer. We do not know. Leasing company to great extent are not the manufacturer or the dealer. They are providing leasing. Therefore, in the case of lessor's books, lessor's books. If the lessor is simply a leasing provider, facilitator, the main income that we are going to recognize in the books of lessor is simply the interest charge or finance income, nothing else. There may be some other items in direct cost that and this, but main income source is the interest income or finance income. If you can keep that in your mind, that is easy. Second situation is there could be a lessor who provides leasing facilities by being a manufacturer or dealer. You manufacture a car or you sell a car. At the same time, you provide leasing facilities. And therefore, there are two things. First one is a trading, selling a machine as a manufacturer or trader. Here there are so many motor vehicle the sellers or machine sellers. So they are simply doing the selling part. Some of those sellers may provide leasing facilities as well. You need not to pay 5 million in one shot. You better pay these things in installment. We'll make arrangement for leasing. They may have a separate leasing company with them, or the same company may operate as leasing company. Okay, what you are supposed to learn is there are leases who provide the lessors who provides only leasing facility, or lessors who provide leasing plus selling. In the case of selling and leasing, there may be a profit or loss arising from that particular sale. That has to be recognized in the year of sale. That happens only in 1 year. But the finance income would continue over the lease term. Okay. To understand the accounting treatment for in the lessor's books, we need to classify lease into two from lessor's point of view. This is the point where risk and reward matter. We ask a question. A finance lease is a lease that transfers substantially all risks and rewards incidental to the ownership of the asset to who? To lessee. Right? Title may or may not be eventually transferred. Don't worry whether the title ownership is transferred. The other leases are operating lease. Operating lease is a lease that does not transfer substantially all risks and rewards to the lessee. So that is the difference. Then some examples have been given for finance leases. This is the major rule or the classification. But if particular lease has some characteristics, similar characteristics like this, you may conclude that this is a finance lease. What are they? Lease transfer the ownership. So simply speaking, any lease arrangement at the end of the lease term, if there is any clause that the ownership would be transferred to lessee, of course, it must be a finance lease for the lessor, not for the lessee, because we do not talk about this thing from lessee's point of view. You have to be very, very careful, otherwise you may make a mistake. But it's a finance lease. The second one is a lessee has the option to purchase. Of course, ownership can be transferred when there is an option. But even though there is an option, lessee may not exercise. So here it says that there is a purchase option at the inception of the lease, and there is a chance that that option will be exercised, the last phrase. Actually, the second point is connected to the transfer of ownership. Second point implies that ownership would be transferred, but may be explained in different terms. Purchase option is there at the very beginning, and it is more likely that this option will be exercised than it is a finance lease. Third point, lease term is the major part of the economic life of the asset. Simply speaking, this lease term, we can understand this explanation in different words. If the lease term is more or less equal to the economic life of the lease asset, it's a finance lease, no matter whether the ownership is transferred or not. For example, lease term is 5, your useful life, economic life is also 5, then finance. Lease term is 4, economic life is also 5, more or less same, 80%, maybe you're right. Lease term is 5, economic life is 4, it's more or less same, you can take it. The lease term is 2, useful life is 5, then that is not finance lease. Fourth point, at the inception date, initial date, the present value of the lease payments, that is the lease liability, amounts to at least substantially all of the fair value of the underlying asset. Again, simply speaking, in simple terms, the value at which you are going to recognize the lease liability is more or less equivalent to the fair value of the underlying asset. That means it's a finance lease. Not only the lease liability, but also all the payments. What are all the payments? Down payment, say 50,000. Lease liability, present value. Any direct costs, just recall the numbers in the previous example, 279,000 something, 188,000 something. It comprises of the present value of lease liability, down payment, and cost. So that is almost same the fair value, same as the fair value. So therefore, it implies that whatever you pay is exactly the fair value. If it is fair, there would not be any other value embedded in this particular asset. Therefore, it would be a finance lease. Last point is special nature. This is very unique. There are some assets we need not to worry about other aspects. Just ask a question whether that particular asset can be used by any other person without doing a major modification. In management or business world, we call specific purpose machines. Suppose that warplane or just a rocket propel used by military cannot be used by others unless having a major modification. Aircraft bought by airline, special aircraft to carry. So good example is the military or any other research or item used in laboratories, scientific research cannot be used as an asset for any other purpose unless you modify. If that's the case, such assets are finance leases because there is no use of that asset for others, right? That is the simple reason, unless you modify. Then same thing is further explained, indication of situation that individually or combination that lead to a lease being classified as finance. If the lessee can cancel the lease, the lessor's loss associated with the cancellation borne by lessee. You can recall this point to the inherent characteristic that I explained you about a lease. Legal nature of a lease contract is it is irrevocable. Irrevocable. You can't cancel. But due to some other reason, if you want to cancel, the lessee has to bear the cost. That is very simple, isn't it? Very simple. So if you see, yes, you cancel it, cost has to be borne by lessee, it's going to be finance lease. So it should be. Second point, gain or losses arising from fluctuations in the fair value of the residual value accrued to the lessee, for example, in the form of a rent rebate equaling most of the sales proceeds at the end of the lease. So this is an exceptional situation. If there are such rebates pertaining to some assets which have unique characteristics where such rebates are required. As a result, fair value varies, fluctuates, then it is considered to be a finance lease. Last point is the lease has the ability to continue the lease for a secondary period. Lessee is given the permission. You lease an asset, but you can sublet. You can use it. You can give it to someone else to use for their own purposes. You buy a machine, sublet to someone else. Therefore, it is going to be a finance lease. Activity 10.5. ACS PLC purchase a photocopy machine for 3-year period. Lease term is 3 years. Fair value of the machine is this much, 450. So the value has been given in a different form. Fair value means from the lessee's point of view, this 450 comprises as from several items, maybe 2, 3, mainly 2. Fair value of the lease liability and down payment or any direct costs. So in one go, amount has been given for the lessor's purposes as 450. This is how you should learn. Where 100,000 is required to be paid as the down payment. You see again. So down payment is 100,000. Therefore, 350 should have been the present value of the lease. The annual lease payment of 148,912 is to be paid at the beginning of each year, starting from 1/1/2020. Estimated lifetime of the asset is 4 years, and there is no estimated scrap value. There is no residual value. Implicit interest rate is 15%. Now you can do a quick calculation if you wish. Take 15% and take this 148 into 4, take the discount factor, present value annuity factor at 15% for 4 years, multiply it by 148,912, it should be almost equivalent to 350,000. That should be the present value of lease rentals, lease liability at the very beginning. Or alternatively, you can calculate the present value individually as you know. How do you do this? Take the discount factor for year 1, multiply it by this, year 2, year 3, year 4, then automatically comes. So no matter, either way can be used. That is the understanding. Now we first understood the question. Another understanding is there in this question. 3-year lease term, but your useful life 4 years. Then the question arises to depreciation for the lessees, for the lessee. Since we do not talk about lessee here, we can simply disregard. If it were the lessee, the question is there. Your question, your task is whether this lease is recognized as a finance lease or operating lease in the books of lessor. What do you say? How do you determine? Because you don't have any clues given here. Whether the ownership is transferred, we don't know. Lessee has the option to purchase. The question does not talk about purchase option. Then we don't know. And lease term is a major part of the economic life. That information is there, but it is also questionable sometimes. These 3 years, 4 years. Therefore, it is only 75%. Can we take 75% as substantially high term? You have to argue. It depends. It's a judgment to some extent that contains some information. Lease term, a substantial portion of the asset will be with a lessee, but it's a little bit doubtful as that substantial time is 75%. Still 25% life is there to live with someone. And the The other point is the present value of the lease payments and specialized nature. Specialized nature is also not discussed in this question. The fourth point, the present value of the lease payment. So therefore, you have to go for a test. What is the fair value? 450. Down payment is 100. Then you need to do that particular test. That calculation will help you to determine if the calculation present value of the lease liability becomes 350 or somewhere very close to 350, it means that 350 plus this 100, it becomes 450. Therefore, it is a finance lease. So you have to quickly decide what to do to answer to this question. Answer is this. You do the calculation, the fixed payment 100,000, then rentals 148, 48, 48. So when you discounted value of the lease liability will be 129, 112, 797. Summation of these three lease liability is 340 plus this 100,000, it becomes 450. Here we take the present value of all the lease payments. Present value of all the lease payments comes from the present value of lease liability, that is this, plus the present value of down payment. Present value of down payment is made at present, therefore there is no difference. The physical amount that you make is the present value, therefore it is 100,000. So that is also called present value. Therefore, finally, present value of all the lease payment, these are the payment that we make, is 440. But if we want to separate it, these three, summation of these three is the present value of lease liability, that is 340 plus this 100,000 440. That's what it is. It is almost equivalent to the fair value. It is 98%. Then confidently, reliably, you can conclude that, yes, present value of lease payment is almost equivalent to the fair value. Therefore, this is the finance lease. Accounting for finance leases. How do we recognize? At the commencement date, that is the date on which the lease contract is signed, lessor shall recognize assets held under a finance lease. So that is an asset held under finance lease in its statement of financial position and present them as a receivable at an amount equal to net investment in the lease. So in this case, we have to first ask a question, what kind of lessor this is, he or she is. Whether the lessor is simply a finance provider or a seller and a manufacturer. This first question example is for a lessor who provides financing only. Financing only. Therefore, if you take this previous example of 450, the fair value of the machine is 450. This lessor has to pay 450. That is his asset held in the finance lease 450. But the 450 is now converted immediately to a receivable. Therefore, once you lease, once you make the payment of 450 to the manufacturer or the trader, you recognize that as an asset held under finance lease in your books. Once the financing arrangement is made and the asset is transferred to lessee, the asset is gone to lessee, but you have a right to recover that amount from the lessee. Therefore, that full amount is lease receivable. Then in your balance sheet, what is seen is lease receivable, 450. Of that lease receivable, 450, immediately you receive 100,000. Therefore, balance to be received, receivable is 350. So it's not revenue for you. It's not revenue for you. It's lease receivable. But what is your revenue? What's your income then? Your income would be the finance charge. First year, you need to calculate what is the interest rate is 15%. At 15%, on that 330, 340 would be your finance charge. If you do a rough calculation, to understand uh, the accounting for finance leases in the books of lessor, need not to think too much. Follow the simple rule. But here, two technical terms have come there. You have to understand. Initial measurement as an asset in your books should be at the amount of net investment. What is meant by net investment in a lease in the books of lessor? It is gross investment. Another term comes. Net investment is equivalent to gross investment discounted at the interest rate implicit in the lease. Gross, we do not know the gross investment in this case, how much has been. So 450 is the net investment. Gross investment would have been a little bit more, do not know. The gross investment, the lease payments plus unguaranteed residual value. Lease payments understood. What are the lease payments in this case? These things, 148 plus this. This is the down payment. That's also a lease payment. Therefore, 440. Therefore, gross investment is going to be straight away net invest like once it is discounted value. So these are the gross. If you add them 148 into 3, 450 with this one 550 roughly. 450. Sorry, 150. So say that this is 150, 150,000, 150,000, 150,000, 150,000, roughly 450 plus this 100,000, 550. So therefore, the gross investment is 550. Once you discount this gross investment 550, it becomes 440. Therefore, net investment is 440. So understanding these two concepts by referring to this example. Okay. But one thing we did not understand as of now, the unguaranteed residual value. What's it? Unguaranteed residual value. So sometimes there would be an unguaranteed residual value. It depends on the real residual value at the time of transferring the asset. That has to be estimated, assessed. But the guaranteed one is the amount accepted by lessee to be paid to lessor at the inception of the lease, irrespective of the real value. Irrespective of the real value. Therefore, the guaranteed one is certainly going to be received by lessor. Therefore, that is included in the lease asset. But the unguaranteed residual value is not that much known, though we estimate and provide these values in the examination to understand. If that is the case, if there is an unguaranteed residual value, of course, that would be an income or revenue or the gain for the lessor. That is why we have to add this unguaranteed residual value. So, however, if there is a direct cost, if there's a direct cost, in the case of lessee, remember direct costs were added to the cost of the asset. Cost of the asset and then we depreciate. But in the case of lessor, initial direct costs are not recognized as part of the asset. Initial direct costs incurred by lessor, other than those incurred by the manufacturer or dealer, so that is something else, include in the initial measurement of the net investment in the lease and reduce the amount of income recognized over the lease term. Right? That has to be recognized as an expense over the lease term. If it is insignificant amount, you can directly recognize in the first year's income statement. But if it is going to be a significant material amount, what you have to do, you have to recognize the initial indirect cost as expense over the lease term. Lease payments included in the net investment. What are they? So net investment, going back to this, what is the net investment? 440. Then you can understand to some extent. Fixed payment less any lease incentives paid. So any rebate, incentives, refund, so that those things have practical relevances. After deducting all these things, what are the fixed payments? In this example, fixed payment is 148,000. Variable lease payments. This is very unusual, exceptional situation, as I just told you. This happens when severe fluctuations in interest rates can be seen in the market. Otherwise, variable lease payments may not be seen. Or the lease payment has been connected to an index or something like this. Otherwise, no. Then any residual value guarantee is provided, that is the guaranteed residual value to the lessor. Then you can take that also if the case may be. Then if there is any exercise value for the purchase option, sometimes the purchase option goes along with the guaranteed residual value. There may be two or sometimes one. In the guaranteed residual value, purchase option may be included. Who knows? It depends. These things are mere agreements, arrangements, and things included in lease agreement. But we must be aware of this. If you have guaranteed residual value and the purchase option price as well, that adds to your cost. Therefore, when you sign a lease agreement, you need to carefully read and understand exactly how much is going to be paid. Then the penalties. Sometimes, so penalties may be imposed in the case of termination of lease. So as this is the connection to the losses incurred by the lessor as a result of cancellation. Therefore, that cost is also paid by the lessee. Activity 10.6. Helen PLC leased a vehicle from Lanka PLC. You are provided the following information. What are they? Commencement date is there. Lease term 4 years. Down payment. This is going to be part of your lease payment. Annual lease payment 80. So 4 years. So what is the gross? So if you want, you can now calculate the gross investment if you want. How? Down payment 100,000. 80 into 4. That is 360 and 460 as of now. Up to this information, if you read the information up to now, down payment this much, annual lease is 80, 80 into 4 is 360, 360 plus 100 is 460 is the gross investment. And not only that, guaranteed residual value is also there. Therefore, guaranteed residual value, that is 20 gross amount. Therefore, 460, 480. Unguaranteed residual value is also there. That has been ascertained. That is 10. Therefore, it is going to be 490 roughly. But the net investment would be the present value of all those payments made after 1 year, discounted at 12% plus this 100,000. So that is the picture that you should have in your mind before attempting the question. Once you read the question, you must be able to grasp these essential points, inherent points, characteristics of this lease agreement. Okay. We will have a look. Ledger account in the books of Lanka. Lanka PLC is the lessor. Extract of financial statement of Lanka PLC. So from lessors for the year ended 31st March 2020. For your convenience, present value of 1 rupee has been given in two forms. Annuity at 12% for 4 years, 3 point something. Remember, recall the calculation I did. So this is what we call, another term for this thing is present value interest factor for annuity, PVIFA, at 12% for 4 years. How do you calculate it? I gave you the formula. You can use either financial calculator or Excel. 1 minus 1 divided by 1 plus R, that is 12% in this case, to the power of n. Here it is 4. Take that value, divide that full value by, again, R, that is 0.1. It will be 3.037. You can, in the examination, if the value is provided, you directly take it and do the calculation. If not provided, you better do the calculation. Now you better practice it. How do we get it? Then you sense it, you realize it. 1 divided by 1 minus 1 divided by 1.12 to the power of 4 divided by 0.12 must be exactly this. Otherwise, there should be something. And the discount rate, discount factor of 1 rupee after 4 years is 0.636. Then simply you can discount. Answer is this. Fixed amount 80, guaranteed residual value is this much, unguaranteed is this much. Therefore, gross investment is this 80, this much. Except that 100,000 that has been ignored. So this is also a part of your gross investment. So gross investment arising from rentals. I think that part is, oh sorry, that is there. Lease payment 80, and that 100,000 has been taken. This is the 100,000 is, oh no, sorry. 80, down payment has not been taken here. So that has to be added on. That has to be added on in the gross investment. Right. Then the net investment becomes this much. Then the lease receivable. Initially, what you can do at in the final books or the balance sheet, if you take this thing as 362, the 0.53, 362,053 is the initial amount to be recorded here. But immediately you take a down payment 100,000. Automatically, this is the net amount. It's all right there. For the simplicity, if you take the net investment available after having the down payment, it is 262,000, no problem. So that is there. At the end of the year, you get another 80,000. Even though you get another 80,000, you are entitled to have your finance income. That is this. That 31,444 something is 12% on this value. You can do the calculation by using your, just take few minutes and do the calculation to understand if you wish. 262,040 into 12% should give you this. I hope you get it. Just try. Take few minutes and try. Okay, it must be that. So therefore, this is recognized as finance income in your statement of profit or loss. The balance would be 213,000. It will continue, go to the next year, and same process is being done. You understand it. So this is just to show you the asset held in lease. Since this lessor is simple finance provider, you pay this amount. That would be 362. That is the fair value. You pay that amount. But you get a down payment. So down payment sometime may have been given to the manufacturer or Dealer, we do not know. So in this question, the down payment has been deducted here, it's all right. So alternatively, you could have deducted down payment here as well. If that is the case, the journal entry requires to be passed for 362,000 and not for 262,000. Here, down payment has been deducted from your asset held in lease. Therefore, value goes down. What is to be received is only this much, 262,040. Simple accounting journal entries that you have mastered over many years, advanced level, and even other sessions in financial accounting that you learn in the university. So in the income statement, that 31,000 directly comes to your income statement as an income, interest income. Since this is a finance provider, you can show this thing under your main source of income. The part of your revenue. Revenue is interest income. It's not separately finance charge. If you do a separate business, and apart from that, in addition to that business, if you do this leasing business, this can be recognized again as interest or lease income generated from leases or something. Then the financial position, the balance sheet, you have, you see, even though you initially, once you made the payment for lease, payment to the manufacturer or the dealer to acquire this asset for by the lessee, you made a payment, but you do not recognize this as like as asset in the name of machine or motor vehicle. Instead, it's recognized as a lease receivable. What is the amount? This, the carrying amount, 213. Yeah, 213. But 213, yes, is divided into two. Non-current is 159. Current is 54. Summation of these two is 213. 213. What is the easiest way of recognizing this current asset, lease receivable, next year? How much are we going to receive? We are going to receive 80. 80. Right? We are going to receive 80. So therefore, it should be this. Your lease receivable in next year under current liability should be 80. But that 80 includes an interest income. What is the interest income? That interest income should be 12% on this. If you calculate 12% on this, it would be 21,000 and some, like maybe 25 something. Therefore, 80 minus that 25 something is 54. You can do the mental calculation. 10% of this is 21,000, 12 would be 2,000 and 4,000. Therefore, it would be 25 something. Not the exact amount, right? Not the exact, 25 something. 80 minus 25 something is 54 something. So therefore, your lease receivable under current asset will be this. Then you have full amount minus this, the balance is 159. Now we will move on to the example of manufacturer or dealer. Manufacturer or dealer. Again, as a simple rule of thumb, remember that if the lessor is a manufacturer or dealer or a trader, whoever you can call, then there is a separate component of profit or loss arising from that particular sale. Most probably, it would be a profit because no one would sell asset at a loss unless you face a very critical condition like COVID or any other market crashes. You may tend to sell at losses. Otherwise, under normal circumstances, you sell at a profit. So, what is your revenue? Value of the underlying asset. If lower the present value of the lease payments accrued in the lessor, discounted using the market rate of interest. So this is your revenue. The revenue means the amount of total sales. If you refer it to this previous example, it would be 362,000 is your um, total revenue. Total revenue. The cost, the carrying amount, if different of the underlying asset less the present value of the current and residual value, if there is any current and residual value, that also has to be deducted. So whatever the amount finally, the cost of the asset, simply speaking, what is the price that you paid to acquire that asset? Or what is the total cost to manufacture that asset? You sold it for 362, but your total cost is 300,000. That is cost of sales. Then you have cost of sales, revenue, difference is your selling profit that goes to that accumulates in the gross profit. It's very simple, need not to worry that much. Just follow the normal rule applicable for recognition of revenue and cost of sales and gross profit. That's it. A manufacturer or dealer recognizes cost incurred in connection with obtaining finance lease at the commencement of the date as an expense. But here, remember, any direct costs of acquiring lease agreement has to be immediately recognized as an expense. But in the case of pure lessor or the finance provider, any direct costs incurred in making the lease agreement, that expense was required to be recognized as an expense over the lease term. But in the case of manufacturer, any expense links with the sale. That is why in that particular sale, we recognize the profit. So therefore, it is logical. Remember the concept that you learned, the matching concept. Matching concept follows. There is a component in the lease when the lessor is manufacturer or a dealer, that component is a profit. You sell and recognize a profit. So that profit arises as of this lease. Therefore, any additional expenses associated with this lease or in connection with this lease has to be immediately recognized in the year in which you recognize your revenue. That is the matching. Actually, if you logically argue, those things can be easily understood. Need not to buy anything. Such cost may include are excluded from the definition of initial direct costs, thus are excluded from the net investment in the lease. So need not to include these things in the net investment in the lease. Directly match it with the profit by bringing or recognizing them as expenses. Now, this activity. Prime PLC leased a machine from Yarn PLC, which is also a manufacturer of this machine, on the following terms. So here, manufacturer becomes a lessor. Then you need to recognize two components, profit and finance income. Date entering into leases. This duration is 3 years, down payment 42, annual lease payment, rentals 42,000, then 42 into 3, 126 plus this 42, altogether 168,000 would be your gross investment with this information. Life of lease machine is 2 years. Useful life is 2. Scrap value at the end of the life is 25. That is the unguaranteed residual value. Cost of the machine is this much. Implicit interest rate is 16%. Cost incurred in connection with obtaining the finance lease by the Yarn PLC is this much. So all the information is there. So since there would be a cost, since this is a manufacturer, this cost has to be recognized as an expense. So you need to recognize the profit. This is the cost of sales machine, and take the sales price, that is the in terms of net investment, that difference would be your gross profit. So your task extracts of statement of profit or loss and other comprehensive income for the year ended 2018, and extract of the statement of financial position as of the same date. Before showing you the answer, we have 10 more minutes to finalize this. Again, read and understand. This question, the activity, has two components of exceptional situation. At least, lessor becomes a leasing provider and the manufacturer. Therefore, the leasing facility or providing of financing facility, corresponding compensation is nothing but finance income, interest income. That has to be separately recognized. But at the same time, this manufacturer manufactured the machine. Manufactured machine sold at its fair value. That is your revenue. But when you manufacture, your cost of production could be less than the fair value. Therefore, it is more reasonable to show the difference between the cost of production of the machine and the fair value of your sale, that is the revenue, as your profit. How are we going to ascertain this selling price? You need to work out your gross investment. Then the answer would be like this. Lease payments, 42, 42, 42. Discount rate is 12, then the factors would be like this. Therefore, actually this is not the discount factor. These are the present value. So, okay, I will make the changes later on. This should be 36,207 is not the discount factor, but we can, so here DCF, actually we can say that discounted cash flow, or within bracket in your calculation you better write it down as present value, present value, present value, or discounted cash flow, discounted cash flow. It's not the discount factor. The summation of these three, 36, 31, 26 is 94 something. That is the net investment, net investment. But plus down payment, that is 42. Your total sales would be 136,000, because what is your gross investment? Gross investment would be this. That is 42 into 3, 126. 126 becomes 94, that is net investment, plus down payment becomes your sales, your revenue. Actually, the only calculation that involves, or the difficulty is to determine this. How do you do this thing? Ascertain lease payments. Gross amount is called gross investment. Discounted amount is called net investment. Net investment. Then total will be your sales minus cost. What is the cost? Is the cost given? Cost of machine is 96. Therefore, your profit is this minus that. It's a simple calculation. What I emphasize or just want you to carefully understand is not this calculation amount, but the concept, how it is calculated, how it is calculated. Then sales this much, cost of sales this much, therefore your gross profit is this much. So in that particular year, 15,092 is your interest income or finance income. How do you get this amount, 15,000? 15,000 is obtained by applying 12% on this, 12%. Your net investment would be 94,000. So 94,000 at 12%, implicit, so 1 minute. Sorry, implicit interest rate is 16%. I'm just worried whether there is miscalculation. I have just taken, this is 16%. I think there is a miscalculation. So here 12%. Just let me check. 37,100. Okay, 16, 36, 862. Yeah, so that is what, like, the calculation is correct, but this information is wrong. You better make the changes there. It should be 16%, right? 16%. So if it were 12%, discount factor is 0.89 something. How did I quickly trace it? Actually, since this answer was available and discussed, and we modified it and copied, since the answer is correct, we simply ignored that 12%. But I cross-checked automatically. I found half. I noted, actually, if you can develop that kind of skills, that would be really good. Like, if there is any mistake or any error, could be easily detected at the time of examination even. What came to my mind was, here interest income is 15,000. It should be exactly the interest charge at the given interest rate on this value. This is your net investment, 94. 94, so here it is 12. When I mentally calculated, 12% of 94 does not come to 15. You got it? So 12% of this, see, 10% is 9,000 something, 12 is another 2,000, then 9, 12, 2 is 11. How come it became 15,000? Then there should be something wrong. That is why I questioned this indication of 12%. That is why I just checked the interest rate. Implicit interest rate is 16%. So we have changed the question, but we have forgotten to change this indication there. Actually, calculation is correct. All the calculations are correct. Change this thing to be a 16% and not 12%, 16%. Once you do 16%, 16% on this becomes 15,000. So the 10,000 incurred in bringing the lease agreement is recognized as one expense for the year. In the balance sheet, lease receivable 36,000, current asset 31,000. How do you take current asset? Your calculation should go to the current asset first. So 42,000. 42,000 minus 42,000 minus next year's interest. That is 42,000 at, sorry, next year's interest would be 16% on this 94. How much is it? 15 something, right? Sorry, that is for 20. Sorry, statement of financial position as of 31/12/2018. This is 18. Yeah, this is 18. So next year. So next year amount. I think there is a miscalculation. Anyway, what you have to do, just check whether that is correct or not. 32,000 should be your 42,000, that is your rental, minus next year's interest. That would be, here it has been taken as 12, that is the mistake. 94 into 16 would be 15,000 something. Sorry. That is 15,000 is for the current year. So sorry, got it. Then it would be, after deducting this interest, This is at the very beginning. Once you make the payment in this year and adding the interest, it would be a different amount. That amount into 16% has to be deducted from this 42,000. So 42,000 minus that interest component will be 31. So it is more likely that your interest income for the next year is not 11,000 something, it would be 10,000 something. You better cross check. It's a matter of calculation. I hope the calculations are correct. Then the subsequent measurement. Lessor to recognize finance income over the lease term based on pattern reflecting uh, um, the constant periodic rate of return on the lessor's net investment. So simply speaking, at this implicit interest rate, you recognize your finance income as they are given in this calculation by using this implicit rate. This is 16%. Lease payment relating to the period apply against the gross investment in the lease, reduce the both principal and unearned finance income. So every time you need to deduct the receivable by the amount paid by the lessee and add the interest component or interest component to the uh, receivable amount. So same procedure that you applied in the case of lessee's books. This is the reversal in the lessor's book. But if it is an operating lease, lessor, no matter whether lessor is a lease provider or manufacturer, recognize lease payments from operating lease as an income on either straight line basis or in other systematic basis. If that is the case, you can recognize the lease income on straight line or by using implicit rate, or that is systematic basis is the allocation of your lease income or finance income in line with the implicit interest rate. Otherwise, you can simply divide it by 5 or 6 based on the lease term, take it. That is called straight line. There is no hard and fast rule if it is an operating lease. It is simply matching the situation of simple hiring of asset. If you hire an asset, take a revenue, take that revenue, the gross amount to your income statement, simply disregarding the time. Then recognize cost including depreciation incurred in the earning the lease income as an expense. So in this case, lessor, if it is an operating lease, the asset is with you, then you maintain your assets held in lease and you have to depreciate them, and other costs, all those things should be recognized as expenses. And initial direct costs incurred in obtaining operating lease to the carrying amount of, in this particular case, just see, in the case of finance lease, the initial costs were not added to the asset held in lease. Instead, we recognize as expense over the time. But in the case of operating lease, asset in substance, asset is with you. Ownership will not be given to lessee. And therefore, asset is with you. You have to maintain these as assets held in operating lease or assets held in lease, and you have to depreciate. But the same way, initial costs, direct costs in bringing the asset to its present condition and location can be capitalized, can be added to the carrying amount. Activity 10.8, we don't have time to discuss it now. Answer is there, but I request you to do it by yourself. I will elaborate this thing when we have the next session on Monday. All right, thank you very much. But I'm sure that today's session was a little bit lengthy and discussed many aspects. The grasping depends on whether you had attempted on activities or not. Honestly, if you had not attempted on activities, you may not have grasped much. So redo the calculation, those who have not done activities, those who have done the activities, again, revise and make sure that you all these concepts are clear. So nevertheless, so attempt this activity 10.8. Next week, we would take up this and explain. But if you have any question arising from other activities, I would discuss them as well. So thank you very much. Have a nice weekend.